Was he a born entrepreneur or simply unemployable? Either way, it's led him to be a leader in the small bay industrial flex space. Today, on the Stories Behind the Door podcast, the founder and CEO of Trowbridge Development, Will Skillman. He's built his career finding value where other people weren't even looking, assembling a portfolio of manufactured housing communities across the Midwest before looking for a new mountain to climb, which led him to be one of the very first folks chasing the emerging interest in small bay industrial flex. Really excited to welcome Will Skillman to the show. I've been chasing him for a year to come on the podcast. Excited to finally have him. Will, I'm going to get to you in a second. I'm going to give a quick shout out to our friends at Kiwi 2 Construction. Wayne Woolsey and his team, 30 plus years of putting up steel buildings across the country in self-storage and small bay industrial flex. If you are looking at a ground up development project, reach out to their team at kiwisteel.com. Touch base with them early and put their 3 decades of experience to use for you. As I said, really been looking forward to having Will Skillman on the podcast. We first met actually at a virtual event I put on in January of 2025, over a year ago. You've been one of those people who's been here every step of the way. Kind of crazy to see the growth and interest that's come over the last year and a half in this asset class. Take me through the journey of how Will Skillman got to be a player in the small bay industrial flex space.
Hey, first, thanks for having me. This is going to be a lot of fun. I look forward to it. I think it's the seeds were really planted years and years ago. In my 20s and 30s, I had several small businesses, and I used this space. I used the small flex space, office warehouse. I had a cabinet shop. I had a countertop fabrication facility. I was a general contractor, so I was very familiar with the space. I didn't get it at the time, so I went on to continue. I've flipped 100 homes and a few dozen apartment buildings. And I was gentrifying and not feeling good about it. And I've studied social entrepreneurship at a business school in England. So I kind of felt like, yes, I'm a capitalist, but I want to solve a social problem. So I jumped into manufactured housing. I was going to solve the affordable housing crisis of 7 million units in deficit around the country. And that is a tough business. I put together some partners, and I had some great partners in the business. And we loved every moment of it. Deep, heavy value add turnover projects in the Midwest. And that's a full contact sport. I mean, there's a lot going on in that business. And I got into that business for a few reasons. One was the affordable housing, but two was it was fragmented, much like self-storage was and the single family home rentals were. And I saw an opportunity to jump on that wave. We didn't get the beginning of the wave, but there was some tail on that wave. And in the end of 24, I decided that I was going to chase something new. And I think the best returns come from getting in early on that wave. And I think small bay is certainly earlier in the wave than I jumped on manufactured housing. So I stepped into that. I knew the asset class. I'm a student of small business. I've always run small business. So I love the tenant base and I understand the tenant base. And I think there's huge possibility for returns in the space. So, and I think it's a much easier asset class than manufactured housing by a long shot. So
take me through that. Dive in a little bit on the attraction. Obviously, you use the space, so you understood it fundamentally, but talk me through a little bit of what excited you to jump into small bay flex. What were the fundamentals that you were looking at?
I think 70% of the industry, and you can define small bay a number of different ways. You ask 10 players and you're getting 10 different definitions of this size, that size. But for us, we play in the 3,000 to 25,000 square foot space. And a lot of that really is, the storage aspect. The contractor garages are kind of under 3,000. And then the true industrial players start to play in after 25,000, in my opinion. So I think there's a gap in the market there. So I identified that. We want businesses operating out of our spaces. We don't want storage. We don't want them showing up in the morning, getting their stuff, closing the doors, and coming back at night. We want them operating, employees on site. So I think there's a huge gap in the market there. I've read that up to 70% of this industry is still fragmented in the so-called mom and pop, which I think is a huge opportunity. And vacancy rates are, under 5%. And in some markets, Louisville, Kentucky, for example, is under 2%. I mean, the opportunity is just massive. I think there's huge upside. And the last thing is existing buildings. I mean, we're buying $60, $65 a square foot in our market. Replacement cost is 120 to 150. So anytime you have that arbitrage, it's a huge opportunity. So I think there's a lot of fundamentals pointing, a lot of signals pointing in the direction of this. There's a lot of wave left in this industry.
What do you think's caused that supply restriction? I mean, anytime you see 95 to 98% occupancy in any asset in real estate, it points to a lack of supply. What's caused that in this asset, in this segment of the industrial asset class?
Well, and I don't pretend to be an expert. We're all learning this as we go along because it's fairly new. But I think some of that consolidation. I mean, when I was growing up, you had a hardware store in every corner. You had general stores, and the Walmarts and the Home Depots and all the big box. So I think there was a concentration. And then e-commerce. I mean, COVID changed everything for us. So e-commerce. So you had this consolidation of those businesses that had everybody focusing on big box industrial. And I think that there was a gap in time there where there wasn't a need for the small stuff. I mean, in the 80s, 70s, and 80s, they built a bunch of it, the masonry, the small office with the warehouse in the back. But I think that consolidation of big box business took the eye off the ball in this space. I think everyone kind of forgot about the little guy. And this country's built on the little guy, it's built on small business. So I think that we're going to see a bit of a pendulum swing back in that direction, especially as AI impacts jobs and productivity.
You make a fascinating point. I live in New Jersey, in between New York and Philadelphia, right? And so on the New Jersey Turnpike, we've seen these million plus square foot
Mhm.
industrial big box warehouses get built. And look, there's multiple Amazons, there's multiple Wayfarers,
Mhm.
there's Prologis signs everywhere, right? But what didn't get built was those 5 to 30,000 square foot units, maybe in 100 or 200,000 square foot unit, where they were looking for multiple tenants in a single space, because the allure of getting Amazon into 1 million square foot space was so heavy but we see everywhere now. Now I drive up and down the highway and there's 4 or 5 of those, million square foot warehouses that were built on spec that are sitting empty, that couldn't find somebody. Meanwhile, in your space, you're looking at 98% occupancy in Louisville, Kentucky, which is a draw, right? That gets exciting as an investor.
Absolutely. Yeah, and I think that, as a developer, you want to develop where the big money is. So I think a lot of developers went into that. They raised some capital. Capital was cheap for a period of time, so you build the big stuff, right? And the e-commerce wave was hard and big, and I think a lot of players just said, "Hey, this is what I'm going to build." And small bay is not the highest and best use always for a piece of ground in industrial. So I just think that people just didn't pay any attention to it. And then you've got this supply demand imbalance now that I think some of us are going to take advantage of, and the players that are getting in and taking advantage of it now are going to do quite well.
You did something that I thought was fascinating. We first started talking you were on 2 different webinars that I did in January of last year, and then again, I think in April of last year. And we started communicating. And at the time, you were working on a ground up development project out in Cincinnati. You did something that I have so much respect for, which is when you understood that that project wasn't going to make sense financially in the long term, you walked away from it. Talk to me about that process and what that was like to go through it.
Yeah, I stepped out of the mobile home park business in, I don't know, October, November of 2024, and it's still going on. Hired a CEO to run that business, and so I just spent 2025 learning. I did a bunch of consulting for some mentors in the space. Just I'm a student of business, just absorbing everything. And I had actually 4 pieces of ground under contract, and I was going to develop. I was all in, and I can get the construction cost to pencil, which seems to be the struggle in other markets. We're at $10 to $15 a square foot from raw dirt finished. The problem is in Cincinnati, where we operate, where these deals were, couldn't get rents, couldn't push rents. Industrial owners have owned these buildings for so long, they just haven't pushed rents in our market. And I had a chat with someone last night, and he's in a bigger segment of industrial, but they're dealing with the same thing. And for guys putting new debt on a new development, you need to push the rents. So we did step back. I kept one kind of hot because I think it's a great area, and we actually worked about 3 weeks ago. We worked out a TIF with the municipality where we're getting a 50% benefit over 15 years. So that's a $2 million benefit on a $12
Yeah.
million build. So we really needed in our financial model for rents to be at 14. And that's modified gross because I strongly believe that these small tenants don't like triple net leases, and that's another topic for discussion. But we're looking at 11 or 12 in the market, so that TIF can bridge that gap in the cash model in the 10-year P&L until rents can get up there. So I think I took a step back and we killed the deals and we focused on one, and then we figured out how to make that one work. And we went to the city and said, "Hey, this is what we need to make it work." And they worked with us. So I think municipal partnership is going to be one of the bridges that can bridge that gap. So it's back on play now, and we're in engineering right now. But yes, I took a hard step back after 15 months of dealing with this development deal, which is hard to do when you've got that much time and energy invested in a deal.
I told you I have so much respect for it. Obviously, I spent the first 5 years of my career in commercial real estate and self storage. And we've seen, and still to this day, and S3 Partners, where I work, we're involved in multiple storage developments. We see people that are 15 months into a deal that no longer makes sense, but they go get it built because they're so far down a rabbit hole that they just, they don't want to stop. And that's easy to understand when someone's a couple $100,000 of committed money into a project. But I have a lot of respect for the people that are able to pull back the reins and say, hey, you have been flipping and kind of going and looking at value add acquisitions in those markets instead. And talk to me about that process of kind of changing the strategy.
Yeah, so I learned from my partners in the mobile home park business, discipline is everything. I mean, we bought most of our parks from syndicators from the coast that came in, toured the properties before closing, and never came back and ran them into the ground, and we bought them at a discount. So discipline has been a huge part of my investment strategy. So for me to walk away from something, to me, that's just intelligence and discipline. So, and there's other deals, right? There's other things you could do. And the last
Yeah.
thing I would do is spend the next 5 years explaining to my investors why we're not making it or losing sleep over a deal not working. So we just pivoted. I mean, value add's what I've always done, from, single family homes to multifamily to manufactured home parks. So getting to the value add play was easy, right? I just go buy a building. I've got all the vendors in my market, which I stay in a small market. I stay small for a reason. I don't syndicate. We own all our own deals, and my vendors. I mean, I let them go, and I don't have to babysit them. So for me, value add is really just an easy play. The bigger issue is finding those deals. Properties just don't trade in our market that often. So I think I've come back to the conclusion that it has to be a dual prong investment strategy of some development and some value add. So that's what we're chasing right now.
So one of the things I've loved about you and following your story, and you obviously post quite a bit on LinkedIn, which I love. I get to kind of see behind the curtain of what you're doing. You've leaned very heavily into AI on every front, not only in terms of helping you operate your business side of it, but the searching for deals, the underwriting deals. Talk to me about you leveraging AI and how you see that and how you use that in what you're building at Trowbridge.
I just like small and lean and mean, right? And so the more I can do, the more workflows that are automated or automated assisted. I mean, I don't run autonomous agents. I just have workflows that help me
Yeah.
work various aspects of the business. I really just want to stay small, and therefore I'm outsourcing a lot of that. Now, um, you can't take it for for gospel, as they say, right? I mean, AI makes mistakes. I mean, two of the three acquisitions we've made this year, my AI analyst said, it's a watch, but it didn't look at the fact that we could convert one lease to a triple net and get a seller note. It didn't take into account that I could pre-lease another deal before closing, right? It just doesn't know those things. So I think you have to value in the human aspect of it. But yeah, I try to layer in AI in everything we do. We automate everything. I self build an entire operating system in Notion. I've got half a dozen or more Claude projects. I just watched an interesting webinar yesterday. I'm going to move them over to co-work, and I'm going to try to make them run a little more autonomously. Right now, if I'm not operating them, they don't operate, and I like that because I have some control. Because I still feel that they make mistakes, and human interaction, human experience, more than anything, really needs to be a factor.
I'm going to kind of take a left turn here because one of the things I love about this podcast and so many of the people that I talk to is the entrepreneurial spirit, right? And you've obviously been someone that's kind of been doing things on your own and trusting in Will Skillman from the beginning. Where's that come from? Where did Will Skillman get this desire to get? Listen, I've flipped houses. That's as gritty as it gets, right? Like you're
Hmm.
out on a limb by yourself, and maybe you get a partner, but you know what I'm saying. Where did that come from? What's the makeup of Will Skillman that makes you chase that entrepreneurial journey?
I'm unemployable, and I have a natural aversion to authority. And I had some great partners in the manufactured home business for the first time in my life, and they'll tell you that there were certainly some challenges there in in us working together. Sorry, my phone's ringing. Transferring it off. Um, So I don't know. I've just always been that way. I mean, I've always, after college, I was a ski bum in Snowbird, Utah for 3 years, and I came back and I just started buying houses, and I'd fix them up and I'd sell them and buy the house next door. I never wanted to be that 9 to 5. I like my freedom. I like the variety, the excitement, the challenge, the stress, all of that. And I'm fortunate that my wife also supports that. Um, Otherwise, I
Yeah.
couldn't do it without a great partner, to be honest. She kind of plays along, but I don't know. I've just always, in every 5 years, I kind of need some new juice, right? And that's why I went through the asset classes, and we identify the signals to get in as early as we can, and we ride it as long as we can. Then we move on to the next one. And I already have my eye on the next one, but I think there's a 5 to 7 year run in this industry. So I think that I don't know. I'm just driven to work for myself, and I don't want to build someone else wealth, and I just really have the drive to do it every day, all day, 7 days a week. And I always tell my wife I want to go to 4 days a week. She said you should probably go to six first. So that's the problem with being an entrepreneur is you just don't you need to be intentional about taking time off. So I'm getting better at that, but I've just always had the drive. I don't know.
When you figure it out, can you send me the playbook on how to make that happen? I'd like to understand. My wife would appreciate that too, honestly.
Right.
Yeah, those Saturday afternoon dates where you're still thinking about something to do with work, and she's like, "Are you here or are you not here?" Part and parcel of the journey. And your point about having a partner that understands it, is accepting of it, is absolutely on point.
Yeah, absolutely.
Talk to me about the investment side of this. As you've gone down this small bay industrial flex, you don't raise any syndication money. How are you financing these projects, and what's the appetite like for them?
Well, I won't say we don't raise any money. We just don't play the syndicator role. I mean, we maintain or I maintain the vast majority and control of the deals. I know a lot of guys will go in and they'll keep 10% and waterfall up to 30% and they raise the rest of the capital. We flip flop that model. I mean, I'll raise 20 or 30% equity stake, in an LP position. If it's a bigger deal and I need someone to co-sign, they might get a piece of the GP. But I'm a big fan of, I don't want to say staying in control. I'm not a control freak by any nature, but I think controlling a deal, I'm the one that's driven. I'm the one with the vision. I know where we need to go. And so I like to stay in control of a deal. In that way I can stay involved, roll my sleeves up, anticipate the problems, solve the problems, and then I'm responsible for it, right? I'm responsible, good, bad, and ugly. And one of the things we did in the mobile home park business is we wrote quarterly reports, not just financial, but I wrote a narrative for every project, for every asset, and it was good, bad, and ugly. I mean, we wrote down the warts, and that way, if you have issues 2 quarters out, your investors knew about it, and you've got a mitigation plan in place. So not that it absolves you from that, but you're transparent and people know what's coming. I mean, there's some operators in the news right now that are taking some big hits in the multifamily space, and I don't think they were completely transparent. And I think that's being authentic about your deals and being transparent and being the majority with the risk is I think is great for our investment capital stack. But we use senior debt. I try to layer in a seller note when I can, and typically as cap rates rise, and I talk to my lenders a lot, they're the first ones to see this, right? So they see appraisals coming in from 15, 20 different deals, and they start seeing it before we do. The cap rates rising. But the sellers haven't adjusted, the brokers haven't adjusted. So there's often a pricing gap. So I've often used seller notes, just 10% of the deal over a 5 year note at, going interest rate often bridges that IRR gap. So with the senior debt and a second note, and then a small LP position, we're able to put deals together. The biggest issue we have is finding more deals. We're in a geographic market where it's just hard to find enough deals.
And again, I applaud your discipline. It's funny because I talk to so many different folks through the podcast, and I see every part of the puzzle, right? People who went with big private equity groups as partners versus people who have gone heavy in the syndication route, people who went the family office route, people who are doing something similar to what you're doing, where they're really keeping a heavy amount of control. You
Hmm.
sacrifice a little bit of scale on that side of it, right? You can't do as many deals, but to your point, especially you, where you're very specific about your geography. Listen, the guys that do big PE deals have zero control, right? They don't get to pick anything about an exit. And I have very close friends who have lost literally hundreds of millions of dollars from being forced to sell something at the wrong time in a cycle. So talk
Hmm.
to me though about that challenge. Like, how hard is it for you? Yes, you retain control, but there's the other piece of it where you're kind of like, do you ever get the shiny object syndrome and kind of look at like, hey, I'd love to go faster? How do you battle that kind of balance there?
Well, I mean, I'd absolutely love to have $50 million fund to go play with, or I mean, some of these guys are raising, a lot more than that.
Yeah.
I've talked to a guy in the institutional space, more than one, and their liquidity events. I mean, they're living and dying on fees, right? And their liquidity events are far and few between. I mean, this is what it is. It's the nature of the beast. Um, we retain, the lion's share of the equity and the risk and everything. So for us, we're building more balance sheet. I don't know if that's good or bad. I can do one deal instead of doing six or eight for the same equity. So for me, do I want to manage one deal for the same amount of equity and upside as I want to manage six or seven deals? Um, we give up some stability, right? I mean, you do 8 deals a year instead of 30, in the fees and all that stuff. I mean, we do give up some stability in that. If we go through a dry spell, the cash stops coming. I mean, the cash flow still comes, but the deal cash, doesn't
Yeah,
come in.
the
So we
fee
give up a
the
little bit
fee
of
cash goes
stability.
away.
Yeah,
Yeah.
yeah. So I think that the guys that build up the family office and the private equity, I mean, they've got a more consistent revenue stream, and they're able to buy more deals and deal flow, and they're able to scale. I mean, I had a conversation with one of my mentors last night. I was like, how do you scale? I mean, how many buildings do you have to scale to actually hire a handful of people? And that's a tough question to ask. But if you have $50 million, you can build that into the fund, and you can just hire people on the front end. Whereas small guys have to sort of get to a point where the construction fees pay the construction manager, the leasing fees pay the leasing manager, right? You have to build that scale up. And so
Yeah.
it's a flip flop of the models. But I mean, being an entrepreneurial, I want to drive the vision, drive the growth, and I'm not doing this to make someone else a bunch of money. I mean, I want to build my own wealth and my family's wealth and my investors and partners' wealth. So to me, I want to stay on the front side of that. I don't want to be a syndicator making 10% and then trying to waterfall up to 30%, and then cap rates rise or something in the market happens where you just can't hit your hurdles, and then you lose a huge part of what you're working for. So I'd rather stay small and entrepreneurial than I would to scale. So I'm okay giving that up. But no, in every respect, I envy every one of those guys at times. Um,
It's so
so,
funny. I had a roundtable on my other podcast a couple of weeks ago with Brett Turner and Jeremiah Boucher were both on there. Jeremiah talked about this. He's got hundreds of employees across his self storage and flex portfolios, and he's like, "Look, here's the reality. It sounds great in principle, but when the market constricts and all of a sudden those deal transactions are not happening in the same volume." I now have to go work for a living, right? Like I got to operate my
mhm.
facilities as an operator because that's where my income is coming from. So, be careful what you wish for, I guess is the message that Jeremiah was setting. And Brett Turner, who, Bootcamp Capital Partners is big of a player in this space as there is, it said the very same thing. In fact, said he and his partner often talk if they had to go choose to take the journey again, they wouldn't do it, right? Which is saying something for a company that's got multiples of billions of dollars of small bay industrial assets to their name. You mentioned earlier people raising big funds. I think they raised a $390 million fund in the last couple of years. So to your point, there's something beneficial about choosing to stay nimble and stay lean and have that entrepreneurial mode. I want to go into something. We only have a few minutes, so it's hard to believe we're 24 minutes into this
Wow.
conversation already.
Yeah.
But I know, right? It is a wow. Every time it gets me. But you started something recently that I love, and I'm excited to be a part of, and looking forward to seeing you grow it, and honestly helping you grow it, which is the Small Bay Industrial Bootcamp. Talk to me about this online community that you built, what led you to build it, and what you're looking to help people get out of having it.
Yeah, I think as the conferences, it's kind of came out of the conferences, right? And I think you look at these industrial conferences and they're all pretty general. And then last year, the year before, I can't remember, Small Bay Summit came out, and then I think one or two others have come out of it, and they've exploded, right? I mean, I think Small Bay Summit specifically was 175 people the first year, and then it went to 650, and you go into that room with
It's crazy.
650 people, and it's yes, there's some great panels and the keynote speaker, and which Brett did a great job in New York in
Yeah.
front of 175 people. I mean, knocked it out of the park, set the tone for that entire thing. The panels were excellent. But you walk into 600 people, and if you're new to the industry, or I mean, we're all fairly new to the small
Yeah.
band, most of us. Brett's been in it for a long time, and some of the other guys. But you walk in, you're like, well, I mean, working a room is challenging. And then you go on LinkedIn, and the conversation is sparse, right? I mean, you interact with the same dozen or 2 dozen people, and it's like, all right, there has to be and people are reaching out to me, DMing me, saying, "Hey, I have questions." So there has to be a generalized conversation. So I went on a platform called School, and I built out a community, and it's free to join. And I think we had 200 members in the first week, and I think we're at 250, 3 weeks in, and we're looking to get more engaged and get the conversation going. But it's been great. I mean, a lot of people have introduced themselves from around the country. Some are new, some have been in the business a long time. And I think my goal is just it's a centralized place to have that conversation, to go to ask questions, to propose deals, to find a metal building vendor, to find a
Supplier. Yeah.
GC, to talk about site concepts or value add strategy. I want it just to be the conversation, right? And I don't want to own the community. I don't want to run the community. I want it to be community run. So I want to implement some weekly calls, but I don't want to be the one that runs them every week. So I'm going to put out a video and ask people, "Hey, put your hand up if you want to run a call, and we'll do some polling on topics, and if people want to talk about deals, great. If they want to talk about AI, great. We'll talk about what we need to talk about." And I think that it's just going to be a great, over time, centralized place to have the small bay conversation. So there's some big players in there. There's some newbies in there, and I think it's going to be exciting in the months to come for sure.
Think is one of the reasons I was so excited about it. And kudos for you having the idea and taking the time, because that's not, I mean, it took you some time to go put that thing together and some resources, quite frankly. But what I love seeing within it is people asking real questions that they
Hmm.
need answers to because they're actively pursuing deals. And where do you go to find those answers, right? If you're building a small bay industrial flex park or you're acquiring a small bay industrial flex park, your local broker is not always the best guy to ask because he's got a little bit of incentive to give you certain kinds of answers. And somebody from a different asset class is not going to understand the dynamics of what you're getting into. So
Right.
kudos for you putting that together and taking the time. As we're starting to wrap up a little bit, talk to me about the drivers of Will Skillman. What is driving you to go on this journey and pushing you to build what it is you're building? What's the motivation?
I mean, it's family, my wife and daughter. I mean, period. End of story. I mean, that drives me. And we don't always know our why. It's not money. It's not. I'm not greedy. I'm not uber competitive. I'm more collaborative. Like I'm not out to build this just to build this for wealth. Yes, I want generational wealth for my family and my daughter and her, kids, and but every day I want to support my family. I want to build a lifestyle that they enjoy, and can do things. And that's it. That's my why. That's my bottom line. Period. I mean, I could say a lot of other things, but when it comes down to it, that's it.
knew there's a reason we get along so well. Our whys are very, very similar. Man, cannot thank you enough for taking the time. I can't believe a half hour has gone by this quickly, but had an absolute pleasure. We'll absolutely circle up again if you're willing to come on the podcast again. Get
100%.
you on the other podcast as well, a little more newsy and a little more talking about facts than this one, which is a little bit more about humans. But it's been fascinating getting behind the curtain a little bit about who Will Skillman is. I can say this, nothing you have answered comes to me as any surprise. You can connect with Will through his website, Trowbridge Development. Get back onto the Small Bay Industrial Bootcamp site. Get yourself logged in. We're gonna have I'm excited to help Will with this piece actually, and we're gonna bring some stuff to that's gonna help the community. He and I together both get a lot of people reach out to us because we're pretty commonly on LinkedIn talking about Small Bay. And I'm excited to help with that, building that community where people can go get access to the resources they need to make sure they're making the right investments and that they're doing right by their investors and for themselves. Will Skillman, cannot thank you enough for taking the time. We'll give one more shout out to my friends at Kiwi 2. Speaking of vendors and finding people to help you put together projects, Wayne Woolsey and his team, they're simply the best crews in steel. They work nationwide. They've been building self-storage since the early 1990s, small bay flex for the last decade, literally hundreds of projects, whether it's pre-engineered metal buildings, light gauge steel, whatever style of construction you need. Touch base with them early in a project. They can help you narrow in on what it's going to look like from a cost and timeline standpoint. The earlier you get them involved, the more they can help you avoid critical mistakes. Reach out to Kiwi 2 Construction. One last time, he's Will Skillman. I'm Thaddeus Campbell. That's it for this week's edition of Stories Behind the Door podcast.